Good morning. We're starting the webinar now. Okay, this is our disclaimer. Please read it. Today, I'll start off by giving an update on Capital DC REIT, which announced their results last week on Thursday. And so we had an update report on Friday. So first thing, this is we still have maintained our accumulate rating for Capital DC REIT, target price 113, and the last close on Friday was $1.02.5. These two tables are summary. The top table shows 4Q versus the forecast that was given in the IPO, and this is for the full year versus the forecast given at IPO. So largely the REIT outperformed its IPO forecast for FY15, mainly due to the contribution from IntelliCenter 2, which was a data center that was acquired, which is a data center in Australia that was acquired in the third quarter of FY15. The update for the portfolio is that the occupancy still remains high at almost 95%, and it has a long WALE of 8.7 years by lettable area. Um, the, the REIT also has a relatively low gearing at 29%. This means that its refinancing risk is quite manageable, and so is the interest rate risk. For FY16, we estimate that the interest cover for the REIT is 6.1 times. Moving on to the update for their lease renewals and expiry this year. So there's about 12% of lettable area which is up for renewal. It comes from a few tenants, but the bulk of it comes mainly from two tenants, one in Citadel 100 and one other tenant from one of their Singapore property. So in Citadel 100 is their data center that is in Dublin, Ireland. So for that data center, there will be one tenant who in the later part of first quarter will downsize from 27,000 square feet to 10,000 square feet. This will result in the occupancy of that particular data center will go down from 77% to about 52%. So the manager will seek new tenants to fill that space. To give some perspective, Citadel 100 contributed about 14% of FY15 gross rental income. As for the Singapore property where one of the tenant is having a lease expiry, that will be in the second half of 2016. And the manager said that renewal is in progress. The tenant will be recontracting for another 5 years, but they just haven't signed the document yet, but it's in progress. Separately, for S25, which is one of their data centers in Singapore, it has an occupancy of about 86% now, and the manager is working with existing tenants to take up more space in that data center. For 2017, they have about 22% of lease lettable area that's up for renewal. This comes from three large tenants, two of them in Singapore property and one overseas. For one of the Singapore tenant, that tenant has given verbal agreement to renew for 5 to 7 years, but contract hasn't been signed yet. For the other two, the manager is engaging them, but as it's still quite far ahead in 2017, so they have not given any commitment yet. But the manager believes that they are likely to renew their lease. So, talking a bit of media report from last week, it said that there will be a 40% increase in supply. So we just want to emphasize that this is a supply in power in terms of megawatts and not a methanol space. So that report also said that there will be new supply coming into these 2 years. So as I've shown earlier in the earlier slides, BC only has 3 tenants in Singapore with leases expiring within the next 2 years. So this is actually quite manageable for them since it's only 3 tenants. Moreover, the sector enjoys rather high tenant retention rate. So there's some stickiness for tenants, and they do not usually shift about the data centers. So what happens is that new space that comes out to the supply, this is typically taken up by new clients and not existing clients from other data centers moving out and then shifting to the new data center. Okay, I'll pass the mic over to Lin Sim, who will give an update on the first week.
Good morning, everyone. This is Lindsay, your consumer and healthcare analyst. So last week we have published a report. With that, we would like to recommend our coverage on Raffles Med. Okay, for Raffles Med, their last close price is at $3.95, and we have actually updated our rating to buy rating with a new target price of $4.74. So as you can see from this snapshot, it actually outperformed the broad index, the STI index. It's giving a positive return as compared to STI, which actually dropped about 20 plus% over the 1 year period. So I believe that most of you are very familiar with this brand name. So I'll just bring you guys through why we think that Raffles Med or Asia healthcare sector is still a good long-term investment play. So these are the few investment theses, and we think that it still remains intact and relevant amid this volatile market. It's actually a multi-billion-dollar industry, and is still increasing, where government is actually increasing their fiscal spending on healthcare sector regionally, and as Asia region itself is actually a magnet for medical tourists, in particular, notwithstanding Singapore itself, Thailand, Malaysia, are actually the rising stars competing for medical tourism. So, and the next one will be on healthcare system reboot. As we can see that there are a lot of reforms drives within the region itself on a healthcare system. So making it more accessible for foreign investors to invest into this particular sector. So we'll be seeing a growth coming from this sector itself, not just from the public sector, as well as in the private sector. As mentioned earlier, it's a long-term play, and healthcare is a necessity. So this makes it a very defensive sector. Just to give you a brief overview on the healthcare system in Asia. So as you can see around us, that there are certain demographics, economic factors that are acting as tailwind to this particular sector. For example, increasing call for increasing lifestyle-related disease like diabetes, high blood pressure, heart disease, obesity. Yeah, all these are actually calling for more healthcare. There are also a group of there's also a push factor from rising affluence. There's a rising middle income class. There are growing health awareness, and also we've been seeing that that healthcare infrastructure is being set up everywhere, hence enhance the accessibility to healthcare services. We are also experiencing aging population, particularly in Singapore, in China, Japan. We are also expecting a longer life expectancy, where we are seeing in the 90s, the average life expectancy will be at about mid-70s, and up to last year, it has increased for about 10 years. So we are now expecting a 80 plus lifespan average in Singapore itself. A growing population, notwithstanding that we are facing aging problems, Asia's population is actually projected to grow by nearly 20% by 2050. So majorly contributed by the emerging markets, for example, Indonesia, Vietnam side. Yeah. Within the industry itself, we are also seeing a margin compression, mainly due to higher operating costs, labor costs, in fact, and there are also calls from government pushing for value-based care. These are the main factors that are causing margin compression within the industry itself. We are also seeing there's a trend for digitalizing healthcare via cloud technologies and high-tech sensors, robotic technologies. So utilizing big data to streamline healthcare operations could be a key to increase efficiency and hence reducing costs as well. So by sharing information, we can actually eliminate unnecessary testing and or medication. Opening up to foreign investors. As mentioned earlier, a lot of governments regionally are welcoming foreign investors to fill the void. So they are actually opening up to privatization for majority of full foreign ownership. Medical tourism industry boom. So globally, we are seeing there's a trend for medical tourism industry. And hence, with all these factors, we still think that healthcare within Asia region remains attractive because that there are limited healthcare providers, and also the technologies are still at infant stage. So going into the specific countries within the Asia itself, where we think that there are developments and there are opportunities. So looking at home, Singapore, we should be seeing that there will be a keener competition, especially stemming from the public sector. Last year itself, we have seen 2 new general hospitals being launched, and we will be seeing 3 more by 2020. And we will also be seeing more polyclinics, primary healthcare being set up throughout until 2020 itself. And we will we'll be seeing that the government are also pushing for more affordable care initiatives. Looking at China is being the world's second largest healthcare spenders after US, but their system is flawed in the sense that there's an imbalanced distribution of healthcare providers, where there are high concentration of medical providers in the urban area compared to the rural area. So they are undergoing some reforms. Being that, for example, they are seizing their one-child policy, starting with Guangzhou. That should boost the demand for healthcare in tandem with the increase in population. And we also see that there are a privatization drive in China where they allows foreign investors to wholly own hospitals either by acquisition or greenfield, meaning that starting from scratch itself, as compared to earlier where a lot of foreign investors are only hospital operators or just to help the local hospital to manage. So all these are actually attracting more foreign investors into the private sector. As for Japan, we are seeing a hyper-aging society where healthcare spending is majorly funded by government. This also induce very low out-of-pocket expense for patients, and this actually led to a lot of patients jamming up, low-risk patients jamming up the healthcare sector. So a lot of patients with higher risk, more emergency case can't really find a public hospital to service them. So there are a lot of cases where they are being rejected by at least 3 hospitals before being admitted. So we should be seeing that the healthcare sector in Japan to continue to grow. And another issue in Japan would be their impending consumption tax hike, which is targeted on next year, April. But medical fees are actually regulated by government and will be revised every biannually. So this is actually a double-edged sword because the hospital providers or healthcare providers cannot have to go along with the government policies when they are setting their medical fees, their services fees. But this also increase the affordability of medicals or healthcare services to the mass, hence balancing the supply and demand. Just on their latest revision, which happened last year, they actually cut drug prices. So that should be able to increase demand for drugs for the public mass, more affordable in that sense. As for Asian ex Singapore, as mentioned earlier, there are rising stars coming from Thailand, Malaysia, and Philippines. So this should be testing the premium price set by Singapore, because they are developing and their progress in their standards, their operating procedures, their technology side. So we might be seeing that there are some closing of the gaps and hence testing the premium price set by Singapore healthcare providers. And they are also being aided by favorable foreign exchange rate. And we are also seeing there is some catching up gains by Indonesia and Vietnam side. So they just started their universal health coverage in 2014. But it is unlikely that this will threaten Raffles Med's markets share, because this universal health coverage is mainly targeted to the poorer population at the moment, and it will take some time for it to grow. So why Raffles Med's? First, it has a very strong brand name. Secondly, it offers a wide range of products and services, ranging from primary care to tertiary care, meaning primary is being the GP, tertiary being the hospital services. They also have consumer products like supplements and healthcare devices. They also have healthcare insurance, provide healthcare insurance coverage. So all this actually helps Raffles Med to diversify their business and weather through big economic environment. They also have a very well-established network. So notwithstanding the medical space in Singapore, they have also representative offices in 11 countries, including Middle East itself. And the recent development actually in particular to referring to the acquisition of international SOS company, which I will touch on later. This actually extend Raffles Med's medical facilities into 10 additional cities. 6 in China, 3 in Vietnam, and 1 in Cambodia. So this should be able to translate to a larger patient base. They also have a very good track record of growing dividend and a strong operating cash flow. So these are the few potential catalysts, expansion plan in domestic and overseas, which remains intact, and they should be able to ride on to regional reform drives. And another catalyst that we might be looking on will be integration across border, including effective use of information technology, of sharing of information of patients, and as well as improving processes such as bulk purchasing of medical supplies. So this is just a brief, this is just a timeline of what's happening in Singapore itself at home. So for last year, we have seen quite an expansion coming from Raffles Medical itself. So they have converted a lease space into 10 specialist centers in the first half of the year. Then later we saw launching of two new, one new medical center at Shaw Center and one new clinic in Rivervale Mall. So coming this first quarter, we are expected to see the launch of Raffles Hospital at Holland V, and the first half of next year would be the 22-story and 2 basements extension from Raffles Hospital. So this extension is expected to increase their bed capacity by 70 to 75%. We also will be expecting that they will continue to upgrade on existing medical clinics to provide better services to their patients. As for our overseas medical space expansion plan, they have actually had a JV with Social Healthcare Management. This is actually their very first foray in medical operations in Japan. Then in October, we saw that they have acquired International SOS company, as mentioned earlier. So with this progress, they will be present in 13 cities. So this acquisition, later on, they will convert the iSource brand name into using Raffles Med's brand name. And we think that this momentum is unlikely to stop, even when they are currently developing on their Shanghai New Bund International Hospital projects, which is expected to complete in the first half of 2018. We think that they will still continue to expand and explore into more opportunities in developing medical centers. And we think that highly likely it will be in Shanghai, because at the moment they have an existing medical center in Shanghai. And with this new upcoming hospital, they will need more primary healthcare centers to feed into their hospital projects. So highly likely with the knowledge and experience they gain in Shanghai, it will be likely that they will continue focus to grow in Shanghai itself. And the next would be on the Shenzhen hospital, which they have announced back in 2013 February that they had an intention to build a 200-bed capacity hospital in Shenzhen, but they have yet to announce any details, and the growth in this Shenzhen hospital has yet to be priced into the current price of Raffles Med. So let's wait and see. And with that, they have also had a few partnership and initiatives with government as well as the International Mayo Clinic Care Network. So this should also be able to expand their patient base as well as heighten their role as a regional healthcare provider. So just to highlight to you on their revenue growth, and we think that the double digit or the near double digit near 10% growth CAGR should be able to maintain, especially with the support from its new hospitals, one being the Singapore side, and another one would be coming from their China side. So in 2016 and 2018, we might be seeing a pop-up in their top line by these new hospitals. However, notwithstanding the higher growth in their top line, they're also experiencing higher staff costs, depreciation costs, as well as operating lease expenses. So just to take note that they have actually having a higher staff cost last year is because that they are actually preparing for their new medical staff for their Shaw Center, for their Holland V. So even before opening of their medical centers of hospitals, they are actually grooming this supply of medical staff. So these are the few peers that we have put into a table for peer comparisons. As you can see that they are actually trading in premium as compared to its peers average. And we think that this is justifiable by its strong brand name, its wider range of services and products provided, as well as its wide network. Just to highlight some investment risks, first it would be on growing competition, not just coming from overseas, but also at home by public sector. We also would be experiencing a very stagnant or lackluster macro landscape and flagging medical tourism at home. So medical tourists are actually flooding towards those countries with favorable foreign exchange rate. For example, Malaysia, Thailand. And margin compression, as mentioned earlier, and significant regulatory changes that might also cause some execution risk. And the general challenge by healthcare providers would be to attract and to retain skilled workforce. So just to recap, we have upgraded our core rating to buy at $4.74 for 12 months target price. Next, I would like to pass on to Jeremy Ng on technical analysis on gold.
Hi guys, this is Jeremy, the technical analyst. So I'll be covering the outlook for gold, also the longer term outlook. So what we actually see happening in gold in the near future is probably a cycle bottom happening in May to October in 2016 this year. And what we actually see is limited downside to the gold. And based on our cycle analysis, more so in the 8-year cycle bottom analysis, as well as the go down cycle patterns, it suggests to us that the gold might actually bottom out in May to October this year. And we think that there is limited downside, basically to the 1032 to 988 support area. And for the upside wise, we should see it minimally target of 1920 all-time high, and the expectation of price breaking through the all-time high. Talking about the Dow Jones Industrial Average and gold cycle, basically we have observed that the gold usually bottoms out 1 year after the Dow Jones Industrial Average tops out. And this happened for both cases during the dot-com crisis as well as the subprime crisis. And one explanation for gold to perform so well during market crashes are probably gold being seen as a safe haven asset. So here's the chart that illustrates the dot-com crisis period. So as you can see, the top panel here is the Dow Jones Industrial Average, while the bottom panel here is the gold chart. So during 2000 January, the market kind of a top out in the Dow Jones Industrial Average here on this vertical line, and this was just before the dot-com crisis. And exactly 1 year, 1 month later, we see gold bottoming out in February of 2001. And this bottom actually used a gain of 305% from its bottom. And moving on, this chart shows the subprime crisis period back in 2007. The market top was formed in 2007 October, shown by this vertical line here. And exactly 1 year after the market top out in the Dow Jones Industrial Average, you can see gold started to bottom out here in October of 2008. And likewise, this bottom sort of yield us a 182% gain from its bottom. And moving on, this is where we are right now, the current picture. This vertical line where I marked up in May of 2015 is where I think the market top is in. We actually did 2 reports on saying market crash signs happening. Probably I'll expand more on that. Yeah, so this was the report that we came out with back in November of last year. So these are the few characteristics that we see. Basically, market will show 4 warning signs before the crash really happens. And these are the 4 pointers that I will briefly go through. So the first warning sign that usually precedes market crash is when we start to see and market starts to show real signs of weakness with big bearish bars, usually bearish engulfing bar or bearish outside bar. And usually ranges from 3.47% to 10.71%. Yeah, I forgot to iterate that this is being observed in the weekly time frame. So as you can see the chart here, the red arrow and the red fonts are the first warning sign that we are getting bearish outside bar ranging from 3.47% to as high as 10.71% over here. So that was our first warning sign, and the second warning sign came when the price starts to close below the 60 period moving average, which is being shown by the blue color dynamic line over here. So this blue arrow illustrates that the second market warning sign is showing with price closing below the 60 period moving average. The warning sign that we actually look out for is when the 20 period moving average, which is the red line, crosses below the 60 period moving average, which is the blue line, demarcated by this blue arrow over here. And that gave us our third warning sign. And to finalize market crash signs, usually is being seen when the market forms a last decade bounce of the 200-day period moving average, which is being shown by this green dotted line and this rectangular box here. As you can see, the decade bounce was quite a strong one, but it didn't manage to reach for its previous all-time high. And when the price starts closing back below the 20 and 60 period moving average over here, that was when the market starts crashing down hard. So this was the fourth characteristic that we spotted during the dot-com crisis. And moving on, the subprime crisis actually exhibits the same kind of characteristic. Point one being the same, red fonts and red arrow shows that they have strong bearish bar falling from 5.2% to about 4.3%, which gave us our first warning sign. And then the second warning sign was bearish close below the 60 period moving average, which was the blue line, shown by this blue arrow here. And thirdly, our 20 period moving average crossing below the 60 period moving average, which is shown by this turquoise arrow. And lastly, the decade bounce of the 200-day period moving average over here, as well as this rectangular highlighted area. The decade bounce ended once we get a bearish engulfing bar closing back below the 20 and 60 period moving average. So as you can see, after price finished its last leg in the decade bounce, being confirmed by this bearish engulfing bar, literally price just snapped down and created. So what we are seeing now is actually quite similar to what we had back in the dot-com and subprime crisis. First warning sign, which is bearish engulfing bar or bearish outer bar ranging from 3.78% to as high as 6.31%. And the second warning sign came here, the blue arrow, when we had a bearish close below the 20 period moving average. And the third point for the 20 period moving average to cross below the 60 period moving average, shown by this turquoise intersection. And lastly, the decade bounce we have seen here when price rejected firmly the 200 period moving average, but wasn't able to sustain the up move, shown by this bearish engulfing bar closing back below the 20 and 60 period moving average. So back then in November, we saw this pattern forming up. And to give a brief update on where we are right now, the market has already sort of taken out the previous year. So this was the area that we have shown in the report back in November, which was this bearish engulfing bar. Price headed nowhere, started to range around this bearish engulfing bar for the next couple of weeks. But as you can see, once the price starts to break below this bearish engulfing bar, that was when the US down happened. And we can see 2 weeks ago we had bigger selling momentum happening in the market, with sellers moving price down 6.26%, shown by this bar over here. So right now we're actually testing the 200-day period moving average again, which is being shown by this green dotted line, as well as a pretty strong support at this area over here, which is a 15855 area. So perhaps in the near term we should see some retracement just for the near term before the market starts to try and test and break this crucial level. And once this level is broken, we should see further sell down to this support over here back in August of 15 at about 15356 area. So moving back to our goal analysis for the gold and Dow Jones Industrial Average cycle, as we have said that the pattern shows that gold usually bottoms out 1 year after the Dow Jones Industrial Average tops out. If our market crash thesis actually holds true, and indeed if the May of 2015 is the actual top for the current market, by moving on ahead 1 year from the 2015 May period will bring us to May of 2016 this year. So this date actually ties in pretty nicely with our 8-year cycle bottom of October of 2016. And hence, in conclusion, we actually believe that the market bottom for gold will come around in May to October of 2016. And however, price might still drift lower in search for a new low for the bottom to form. And we think that price might drift lower to around 1032 to 988 support area, and after which the bottom should actually be formed. it's usually a good time to start accumulating now, because there was an instance whereby price didn't search for a new low before the bottom was formed. During the 1993 to 2001 period, you can see the bottom actually formed prior to the cycle bottom here. So we might actually be experiencing this scenario right now. So for those who are afraid of missing out on this train, it might be good to start accumulating some now. And so yeah, we have a minimum target of at least 1920 all-time high area, and with expectation of price breaking through the all-time high. And one tradable instrument to utilize on this trade is perhaps the ETF for gold, which is the SPDRGLD. Okay, and so this is the summary chart that I've come up with. So this is the monthly time frame chart on Vivo. So the vertical line that I marked up is May to October of 2016, which I truly believe the bottom would more or less be formed around this area. And the horizontal line that is being drawn here is to illustrate the support level that I think the bottom might actually be formed. So all in all, if the bottoms really forms around this area, we should see a minimum long-term target of this all-time high area of 1920 area, with expectation of price breaking through the previous all-time high, as being shown by the bottom and bull market run from the subprime and dot-com crisis.